here at Encore Funding, you do accounts receivable financing.
So accounts receivable financing is a different way to look at accessing capital.
Why is it that the bank doesn't finance the contract?
They simply don't understand the value that's sort of locked up in that contract. The challenge for them is they don't really have a product that works well to extract the value out of that.
What are some of the misconceptions about this?
Some of the misconception is you can only go to the bank and access capital. For us, there aren't a lot of minimums. We're comfortable providing those funds to you before the value is realized.
Now, that sounds really too good to be true.
More than one person said to me, you mean to tell me that there's places other than a bank that I can get money from and borrow? And I said, absolutely.
This is Eric Coffie here at Encore Funding's offices with Craig Cohen, the VP of Business Development. Craig, how are we doing today?
Good, Eric. Thanks for having me here.
Great. So today we want to talk about what is financing, right? We have a big community out here of small businesses that are interested in learning about financing. We hear about all these different products out here, and we're just unsure of, because we just don't have that experience, right, to pull from, of what type of financing exists out there in the world. And I know that you've got a lot of experience in that. So we want to talk to you about your experiences so you can help educate all of us out here listening today.
A lot of choices out there, Eric, and a lot to figure out. So I'm happy to break it down and on a very basic level. So people who don't, I think the biggest thing for people get intimidated by and to have the challenge of overcoming that is there's so much information out there. They don't have the business or finance acumen. So they're intimidated by someone who may have that information. They're afraid that they're not going to understand what's being told to them or given to them or being written in a document. So I really want to break it down so people feel comfortable asking those kinds of questions, looking at that information, and feeling educated and empowered to go out and have those conversations.
Great. So tell us, we start with your background. Like, where's your background? Where you come from? How did you get to where you're at today?
So I started out, I like to tell clients I'm a recovering banker. I started out in very large formal public banking. I did that for about 15 years right after I finished grad school, and started out as an analyst in a very formal credit program. Worked my way up. I was a portfolio manager. I did loan workout and asset recovery during the 07, 08, 09 sort of market correction, which was an interesting time to be in workout for commercial lending. I also worked at some publicly traded community banks. And so after about 15 years, I was introduced to a group of local finance entrepreneurs. And so I've been doing the past 13 years working in specialty and alternative finance, and had a variety of roles, mostly credit related and overseeing a lot of risk management and those types of roles.
So the little knowledge that I have about finance and banking was through the acquisition of real estate. I've owned a bunch of real estate. I still do. So I know about the different programs for real estate financing, but our audience are small businesses that are selling to the government. And so we really want to know, how do we connect with that type of finances? Do you have experience in that area?
Yeah, I do. Both in the traditional banking world and in sort of specialty finance like we do today.
And so in the banking world, what type of companies did you guys lend to?
We lend to all different kinds of companies. The banking world likes to segment their business by the size of the companies that they're lending to.
Sure.
So they refer to them as small business or business banking. Then it goes to sort of middle market, which is like an SMB type, the overwhelming majority of small businesses in the country. And then the upper middle market or capital markets is what they call sort of the higher end.
Okay.
You get into the tens and hundreds of $1 million in revenue.
So for me, when I think about small business, I use the federal definition of small business. What was the banking's definition of small business?
Bank doesn't really have those like specific definitions. They sort of make it up on their own, and they like to fly by the seat of their pants. But for the most part, they sort of think about it in terms of how they're going to lend those dollars. So they don't necessarily cap it at how big the business is that they're lending to in terms of size of revenue or number of employees, which I know is important in the federal space.
Right.
It's less important for the bank. The bank really thinks about it in terms of the size of the lending facility that they're going to give to that borrower. And so for business banking, that's typically usually between some banks it's 50,000 or under, some banks it's 100,000 or under. So there's a lot of newer businesses that typically fall in that because they don't have the financial history or wherewithal to be able to borrow much more than that. So a lot of the small businesses fall into that category because the bank doesn't feel like they have the ability to borrow or make payments beyond, $25,000 or $50,000.
We even still find it's hard to get traditional bank financing for $50,000 or $100,000.
It is. And the problem is banking, while most people think that's sort of like the gold standard, it is very difficult because the bank's rules are very black and white. It's very rigid, and a lot of small businesses just simply don't qualify, not because they've done anything wrong. It's a very matrix driven system for the bank, because in order to have a system at scale, national scale that they do for many of the banks that are, the top 50 or 100 banks in the country, you have to have a very simple process that people can follow at scale. So they often are saying, well, you have to be in business for at least X number of years. It's usually 3 years. They want to be able to see financials or tax returns for those 3 years. Well, many businesses right there, that disqualifies them because they just haven't been around. So that's something that we think of here is that's not a disqualification. You shouldn't be penalized because you just didn't exist. But as far as the bank thinks about it, they're just simply saying, well, you don't have that information. Sorry, we just can't even look at that. So things like that, minimum credit score, as we think about as individuals, what's our credit score?
Right.
If it's not above a certain threshold, you're automatically, that just doesn't fit in our box. Sorry, you got to go. So things like that. And that's what makes it really challenging to be able to sort of fit in the traditional banking box. And by no means or fault of your own, you may not fit in there, but the bank doesn't really care about that. It's got to fit in their box because they like comfort, they like predictability, they like stability, and many small businesses are sort of still figuring it out. And for clients that we work with, and especially in this particular space, we see a lot of volatility, and for us that's a good thing. We like clients who are growing. We like clients who are winning new business. The bank doesn't like that. That makes them uncomfortable. They see these lines going up and down as businesses being won and contracts burn off, and that's okay. We understand that. But banks like to see that sort of that steady plateau, predictable, makes them sleep at night better.
Sure.
We like the growth. We like to see those upward trajectories. And for them, it's just, you can't predict that. There's less stability in that, so it makes them uncomfortable.
So here, from my understanding, at Encore Funding, you do accounts receivable financing.
We do.
So tell us, what is that?
So accounts receivable financing is a different way to look at accessing capital beyond traditional financing. So when we think about traditional financing, you can go to the bank, you can get a line of credit or a term loan. That's probably the most basic ways that you can access capital from a traditional bank.
Okay.
Accounts receivable financing works a little bit differently in that you have your main assets as a service-based business typically would have accounts receivable. You go and perform a service, you work for a government entity, you have a contract that you won, you've been awarded, you go and perform that service. There's some kind of something that you're delivering on. You are then in turn sending an invoice. We've completed the work. This has been done. We had a project that was completed. We did work that was now installed, whatever the case may be. That invoice is now an asset to you. And because you've performed work, it's being sent to whatever contract that you've been awarded, whatever entity of the government, and that's now due and payable to you. Well, you can leverage that asset as collateral, and a specialty finance company like Encore will allow you to borrow funds against that. And so all we're doing is taking that invoice and we're accelerating the time frame that you can access that cash. Because normally you're going to have to wait depending on when you're allowed to bill, the frequency at which it gets paid. Sometimes there's corrections on it, mistakes, things that need to be adjusted. You could be waiting 30, 60, 90 days. But when you work with a specialty finance partner like Encore, we're going to accelerate that to the moment you create that invoice. On that same day, we're going to turn that into cash for you up front. And so you no longer have to wait to get paid. And it's just a different form of accessing cash versus, the typical way people would think about accessing a line of credit and just saying, well, I just need to borrow a few extra dollars because I have certain obligations for the business that need to get paid. Other payables, we need to keep the lights on, we have computers, we have payroll that needs to get done, whatever the case may be. And so by using your invoices as collateral, we know that those invoices are going to get paid. It's just a matter of when. We know that the government has the ability to pay that. We know that their wherewithal is just fine. I'm not concerned about that. So it allows us to accelerate that payment, and you can get money from us that same day instead of having to wait it out and continue to put out your own cash until that invoice comes in.
So, what's interesting about that is when I first started teaching online, a lot of people were like, yeah, I can take my contract and I can just go to a bank and get money. And so I've heard these stories countless times where people are like, Eric, I took my contract to the bank and the bank was like, that doesn't mean anything for us, right? So can you, I mean, because that's what people say, right? This is what I'm hearing from people like, Eric, I took my contract and I went to the bank, and they're like, okay, So why is it that the bank doesn't finance the contract?
There's a couple reasons for that. One, the bank in general just doesn't understand how those contracts work.
Okay.
They generally don't understand that there's a fixed period of time. Some of them have variable components. Many of them are fixed price in nature, that there's renewal periods. They don't understand the sort of the mechanics of how those contracts work, and the billing cadence that goes along with that. They simply don't understand the value that's sort of locked up in that contract, and it's going to be realized over an extended period of time. So they're just unfamiliar with the space. So they essentially don't know what to do with that. They don't even realize the monetary value that's locked in that. So problem number one is they just simply don't understand the space. Problem number two is that if you were able to explain it to them, which is challenging in and of itself if you're just not familiar with it, now they don't know how to extract the value. So first they have to understand it. Now they have to have a vehicle to extract it. And the problem with that is the contract, while it has value, it has future value. Today it doesn't have any value because it hasn't been realized yet. So people sometimes make the mistake in just thinking, well, I have a contract here, it has value, I'm just going to take it to the bank and I'm just essentially going to cash it. Right. It's like a check.
Right.
And so can you just, this is a $10 million award, can you just write me a check for $10 million today?
Sure.
And I'll just give you this contract? And it doesn't quite work that way. So the challenge for them is they don't really have a product that works well to extract the value out of that. And when you work with a specialty finance lender like Encore, we have the ability, as time goes on, and you in the intervals, sometimes, whether it's, most of them are monthly billing and invoicing, as the work is being performed, regardless of what the work is, we have the ability to then turn that and extract value out of that. We know that generally, for the most part, there's some adjustments sometimes for a variety of reasons. We know that for the most part, there will be a set invoice number, and the contract for the most part will not change during the initial period or the subsequent renewal periods. Most of them are through for 5 years. So we're comfortable and we're confident putting dollars out on the street and helping you extract some of that value in order to meet some of your payroll requirements or whatever the cash you need to use it for, to make sure that the project keeps going, to make sure that people can go and execute on whatever the agreement's for, to manage the facility, to work on a systems upgrade, to make sure that you can buy hardware and have the team go out there and deploy and install it. We're going to be able to provide and extract the value long before the payment comes in, because we know that the mechanics of how that's going to work and when it's going to happen. We're comfortable providing those funds to you in monthly increments before the value is realized, to help you go and run your business, and you can have the cash flow that you need to operate that on a regular basis without having to wait, essentially sitting on your hands until money's coming in. So then you can go and spend it and put people out on the street, or going to offices, or maintaining facilities, or whatever the case may be.
That sounds really too good to be true. I mean, I like it. Listen, I like it for my people. That's why we're having a conversation. What are some of the misconceptions about this?
I think some of the misconceptions that people think when they have invoices and it becomes an accounts receivable, that they're not quite sure what to do with it. And they think some of the misconception is you can only go to the bank and access capital. I had the pleasure of coming to your conference last year and met some really great people there. And more than one person said to me on multiple occasions, which I was absolutely surprised by, but it really sort of gave me this renewed excitement. They said, "You mean to tell me that there's places other than a bank that I can get money from and borrow?" And I said, "Absolutely."
Right.
So I was surprised, and maybe that was a bit naive on my part to think that people just knew that there was other options out there. Right. So I was really encouraged by the fact that people were saying, "I didn't even know this existed. I didn't even know that there was alternative places to go other than a bank." And I also talked to a lot of people that said, you know what, I got turned down by the bank because I've only been in business for 2 years.
Right.
Or I didn't have enough revenue. And so I think some of the misconceptions are, one, that a bank is the only place you can go and get capital from.
Sure.
Certainly not the case. There are plenty of places, certainly alternative and specialty finance partners like us. Some of the other misconceptions I think are, well, you know what, if I don't go to a bank and I go anywhere else, regardless of what that finance partner looks like, it's going to be way too expensive. So if it's not a bank, for some reason people just automatically assume that equates to exponential cost.
Right.
That really isn't the case. We find that our cost structure is fairly competitive with a bank. And we have seen over the years that clients come to us from banks. They're with banks, and they've realized that the cost is relatively similar. It's competitive with the bank. And the thing that what they're not realizing is that they're getting way more flexibility with someone like us because we have the knowledge and the ability to provide them with additional dollars that the bank simply just can't and won't, because we talked about sort of this little box that it's got to fit in. If it doesn't, the bank doesn't like that, and they're going to throttle your ability to grow beyond that. So I think beyond the misconception of thinking about the cost, I also think that people have this association that it is this sort of subprime place, that it is this seedy underbelly world, and it's, we have these meetings in back alleys, and you can tell we're in a nice place, and we're friendly faces, and we have been doing this for a long time, but we have taken every opportunity, whether we're talking in interviews like this, or at trade shows, or meeting people face to face in their offices, every opportunity, so people can realize this is a friendly place to be. These are people who have higher integrity and want to make sure that we're partnering with businesses so they can accomplish and succeed and feel like they're meeting their goals and objectives, and whatever that is for their business. Because we are entrepreneurs just like all these businesses are. And we want to make sure that we take the time so they feel the same. And so I think that's the biggest misconception, is that there's this sort of like gotcha, and then maybe it is too good to be true, and it's probably going to cost me way too much. But that's absolutely not the case. And if people go out there, the Google is a powerful place. There's a lot of information out there. Look what our clients are saying about us. Read some reviews. I can't say that about everybody else in the industry. I can only speak to what we do here,
right,
and how we operate. And there are plenty of people out there, unsolicited, that will tell you that we're doing everything we can to make sure that we're operating above board with transparency and in true partnership with clients, so they can succeed and feel good about what they're doing on their journey to grow and be successful in their business.
Well, it's interesting. You bring up a good point, because you brought up, you met people at my conference this past year. And so I think you actually have a success story from the conference.
We do. We met a really nice gentleman who was at the conference. And I don't even think he came there with the idea of, I need a new lending partner.
Right.
But it wound up being a great success story for all of us, because we had a breakout session that we were speaking at.
Sure.
And it was about access to capital and alternative capital.
Right.
And he attended our session, and there was a lot of people there, and people asked, I think the most important part of that entire breakout session was we saved time for Q&A at the end, and we probably could have spent twice as much time for Q&A, because people were really inquisitive about the types of capital that we offer and the mechanics of how it works and the cost structure. And people were sort of, becoming really inquisitive in their seats, and the wheels were turning, and they were sort of saying, like, this isn't the misconception that I thought it was, and people were really being curious about it. So this gentleman came up to us afterwards, and he had some more questions, and we talked about it at length, and we kept in touch. We talked for a couple weeks shortly thereafter, and I think he was sort of also in the same camp where he was sort of saying to himself, I don't know if this is really possible.
Right.
Because he, on more than one occasion, he's like, I just don't see how this is going to work. I don't know how that's possible. He had two other lenders that he was working with. He had an existing SBA loan, and he was also working with another local bank. He had a line of credit with them. And the challenge for him was, He was still making payments on his SBA loan. It's a term loan. You just have a fixed payment you make every month, no different than if you're making a payment on a car or a house. It's just a set number. And he also had a line of credit. So as he was focusing on facilities maintenance. So he has people that go out and manage a lot of different government facilities. So the challenge for him was, as he was winning new contracts, he's got more people that are going to work each week. He's got to make sure he can only bill at each of the contracts get billed at the end of each month. But he had to pay payroll twice a month before he could even bill. So he has a math problem in his hands. He's got to make sure that he's got to pay all of his employees twice every month before he can ever send out his invoice. Plus he has to wait then another 30 days before he gets paid. So he has to run an additional 2 payrolls. So now he's 4 payrolls in before he receives any payment from his invoices. So his bank line was maxed out. He couldn't get any more credit from the bank. They said, based on your size, this is as much as we're comfortable giving you and allowing you to borrow. And just like a credit card works, they said, until you pay it down, you can't borrow anymore.
Right.
And so he's stuck in this position, as we see many clients in the space, where you can't borrow anymore, but you've got all these great contracts in the pipeline. And he had a brand new contract that was starting Jan 1, and it was going to double his business literally overnight. Wow. And so now he's in a panic. He can't borrow him any money from his current bank. Yeah. He has a new contract that's starting, and as we just walked through that example, there's a lot of dollars he's got to put on the street to make sure his people get paid. He wants to make sure that they show up, and he certainly wants to make sure that he performs in his contract because he doesn't want to lose it, especially on the new one.
Right.
So we were able to make sure that we paid off his SBA loan, we paid off his bank line, and we made sure that going forward, he had the appropriate amount of cash to make sure that he met his payroll every other week. And when he would send out his invoice every month, we would turn that into cash, make sure that he was able to get all of his people paid, and he's off to the races. He is ecstatic, and we're thrilled for him. His business has doubled, and so he's 2 months into his new contract. He's got 3 contracts that are in the pipeline, which he would have had to otherwise turn down, and he stayed in his current financing situation. So those are the kind of success stories that we love to hear, and those are the things that banks want to shy away from. That made them nervous. We're high-fiving when he's calling me and telling me, I've got 2 $10 million contracts in the pipeline that I've bid on and I'm waiting to hear back. I'm giving him a virtual high five. You tell it to the bank, they're cowering under their desks because that makes them nervous. That that sort of goes back to the volatility. But when we see that makes us really excited, because when our clients win, we're going to win together. And so it was a really exciting story, and it was a success for him and a success for us.
Yeah, I can't tell you. I have one of my female students out of New Jersey, and she had that challenge and she was in a facilities maintenance space as well. She's like, Eric, I can't get financing for these projects, and so I can't accept them because I cannot get capital for the projects. And it's interesting that you mentioned about Google, because even myself, even with government contracting, as a person that's been teaching it now for 7 years online publicly, you don't even know what to Google. So if you don't even know this thing exists, how do you know to Google? Like, why would you even know Google alternative lending? Like, that's not something that you think to Google, and that's why we're here today, because I want to educate people, which is what I'm known for, is giving people the information so they can go out and make better decisions, be well equipped so that they can grow and scale their business. So for me, that's great. Now, talk about some of the eligibility factors, because obviously you said you're different from a bank. So, you don't have to have 2 years of history, but what are some of the eligibility factors or criteria that people need to have?
So it's fairly minimal. So when we talk about eligibility, a bank is going to say you have to have a lot of minimums. Minimum amount of information you have to submit, minimum amount of time in business, minimum years of, minimum revenue amounts, minimum credit score. For us, there aren't a lot of minimums. So there is no minimum amount of time in business. If you've only been in business for a year or two, that's okay with us. If you've been in business for 10 years or 20 or 50 years, that's okay with us too. Sometimes the banks will say you're either too big or too small, or depending on the size of the bank, or just maybe it's not a top 5 bank and they have trillions of dollars to lend out, but maybe it's a community bank and they have to be a little bit more careful. Oftentimes community banks will say, there is a top end to this. You might be too big for us because you may skew some of our loans, and that may be too big for us. But I'm also proud to say that we've got a very strong balance sheet and a large enough capital structure that there really is no top end for us either. So all are welcome here at Encore Funding. The other thing is, banks are notorious for saying you have to have a minimum credit score of X, and sometimes it's a pretty high hurdle to get over, and sometimes that's 650, sometimes that's 700, and if you've had a couple blips in your past, it's very easy to drop below that. We're not here to judge anybody. We're not here to say, because you've had indiscretions in your past. We realize that people go through different challenges in their life. People get divorced. People have medical problems. People go through other catastrophic events that present problems that lead to financial challenges. So we don't have a minimum credit score. That's one of the very first questions people like to ask me when we're talking about a new relationship. They say, you know what, I don't have the greatest credit. Do you? What is that going to affect my chances? And my response is, we don't have a minimum credit score. And I think the reason that we do that is because we like to look at your business and your opportunity holistically. And that phrase is sort of becoming overused and overstated. But what I mean by that is there is not several data points, like a bank will key in on certain data points and say, if your credit score is below this, that's automatically a decline. If you don't have this many years in business, that's an automatic decline. There is no one data point that we say, if you have this, that's an automatic decline. And when I say we look at holistically, I mean, we like to look at all the facets of your business. We look at the business itself. We look at the owners of the business. What's their experience like? Do you have history working in your space, in your vertical? Do you have history working in and around the federal government space? Do you have history operating the business? Do you have history owning the business? Do you have history in the financing space? What is your background, your specific background look like? What is your personal wherewithal? And there isn't a negative against that. If there isn't, or you don't come to us and you don't have millions of dollars of net worth, that's not a ding against you, but that's why we sort of look at it all together. Then we like to look at, okay, what does your customer base look like? Well, for many clients in this space, it's the federal government or various branches of that. So that's always a check in the positive category. And what does your customer list look like, or what do those contract mixes look like? Is it, are these just all short-term agreements that are all 1 year, and are you about to burn off of all of those? You only got a couple months left, or are these 5-year agreements that you're in year one of every single one, and we know that there's a long runway ahead of that. So we sort of like to look at the big picture and not sort of pick out these one thing here or there and say, nah, I don't like that. This person, they had a bankruptcy a couple years ago. They got really sick and they couldn't pay their bills, and they had to file bankruptcy. So you know what? We're just going to pass on that. And believe it or not, that happens frequently here, that we see that. Mm-hmm. And we're often sometimes the lender of second chance. And I don't like to put it that way, because past challenges people have experienced shouldn't be looked at as second chances. Right. Because you shouldn't be penalized for other things that may have happened to you that were out of your control in situations like that. Absolutely. So we'd like to be able to say, what does the business itself offer? What does it look like? And sort of look beyond just data points on a sheet. Yeah, makes sense.
A couple things. And by the way, I do have an experience with community banks before. They're great. I remember them giving me loans, but to your point, you definitely cap out with them. Yeah. And I actually, when I was doing construction, I had Bank of America and I had a community bank. And while I love my community bank for giving me loans for my real estate investments, when I had to write a big check, I had to get two people authorization to cash like a $30,000, $50,000 check, and I'd be like, Bank of America cash a $200K check for me without any authorization, like just my signature. Yeah. And I was actually embarrassed because I'm working with these big contractors, and they go, "Oh, Eric, the check won't cash," and I'm like, "The money's in the bank." Yeah. And I call the bank, and "Oh, well, this check is over $20,000, so we have to get your authority before we cash the check." So I totally know, and I was like, I'm no longer, I mean, I kept them for my real estate investment stuff, but for my construction side where I had to write checks, above a certain amount, I didn't even deal with it. So
It's good for more local stuff.
Yeah.
That's what I mean, by design, the name of a community bank is to serve in the community.
Right.
But when you start to get bigger and you're on a larger scale, or you're serving on projects or doing business beyond the community, it may not be the best solution for
yeah.
you.
So no, it's a great place to start. I mean, they gave me a shot.
It
They gave me
absolutely
money
is.
and capital, and I bought.
That's what they want to do. The idea is to continue to reinvest and give loans that will prop up in the community
Yeah.
and develop and rebuild. And
You know, it's another interesting I will say about the community bank is that for me, I bought my real estate in a business name, and they did not report the credit that I'm using to pay it. And I'm like, wait a second, I paid all this money to you guys, and you're not reporting my credit score, so I'm not even getting credit for the money that I'm paying to these people. So I thought that was an interesting thing. But back to you, a question I have. I know you mentioned government. Do you do state, local educational space in terms of government as well?
We do.
Okay.
The
Because we're federal here, but I didn't know if you do state and
Yeah,
local
we
education.
do. We have done over the past many years. We've done more so probably at the state level.
Okay.
And we've certainly had clients working at the local and municipal level.
Okay.
It really just depends on what those contracts look like and the financial wherewithal of those entities. We know what the financial wherewithal is of the federal government. We
Right.
can look at that information all day. And for most state and local municipalities, we can also go and get that information. A lot of that
Okay.
is published and it's readily available.
Right.
So we can see if a city or state is doing well financially or is having budget problems, and we're able to look at that very quickly and
Right.
make a decision, and we know this is or isn't a good decision for us as a business and for you as a client. You may not, if you're thinking about working with one of these as your customer, you may want to think otherwise, because you just see it and you just think, well, here's a contract and it's a $5 million with, the local city, and maybe that city is not doing well. Maybe that
Right.
city is experiencing some hardships and whatever the case may be. But you're not generally looking into that. That's stuff that we're looking at all day long. We have an army of people that research that. So it's an important component to understand before putting things out to bid.
Right now, though, you're focused on services versus goods. Is that the case?
Yes.
Okay. I just want people to know, because I want people obviously who's listening to this,
Yeah,
and
you know,
I know it's a big market in our space where people do goods and services.
It
but
is.
For now,
Our primary focus is on the service side for a couple reasons. We've done things on the goods side. There tends to be more room for error on the goods side, and what we have found on the service component is there's less room for ambiguity. So whether it's a staffing component, whether it's consulting, whether it's staff aug, whether it's project based type work, there's less room for ambiguity, because if you have a project and you're delivering a service, it's pretty tangible to be able to measure that Eric was for last week. Eric was supposed to be at this particular location. He was supposed to perform these duties, and it was going to take him 40 hours. And there was somebody else on site from the representing entity. They confirmed Eric was there. He was there for 40 hours. They signed a sheet, or there was some electronic tracking mechanism that Eric signed when he got there and when he left. And everybody agrees that Eric was there for 40 hours. On the good side, there's a lot more room for error when you're either ordering things get either broken or busted or lost in transit. Things arrive and they're either not done to spec. Perhaps you're ordering 10,000 pens and they're supposed to come. This one has a blue ring around it, but you accidentally pulled the wrong drop down and you ordered it, and it's going to have a red ring. And now the problem is, now you have a lot of pens and they're not going to accept it because it didn't meet the specs. Or maybe you were had some other goods, and whatever the case was, the measurements were supposed to be, everything was supposed to be 2 feet in length, and you were an inch short on whatever the measurements were, and they're now delivered, but now they're going to refuse delivery because the specs were wrong. And so there is room for error when these things happen. And if we're financing the purchase of the raw materials or to order the goods, there is more room for error when some of those things arrive in either incorrectly, or there's damage, or there's something wrong with the order. it often gets refused and for non-payment, and it's much more challenging both from our side and from our client side to then go make that right and figure out who's going to bear the cost to then fix it or even reorder it, or then have to go liquidate whatever the incorrect supplies were. So to your question, Eric, we focus much more on the service side.
But if you have a service that includes a good, definitely, I mean, it's something that's a possibility.
That's definitely something that we would certainly take a look at. In particular, like on the IT side, we know that there's oftentimes where an IT consulting component would have hardware that has to get ordered and then deployed for installment, and then they're going to be in charge of the actual installment and configuration of that system. So that's something that's going to have goods and services, and that's something that usually the service component is going to be a larger proportion of that.
Right.
And those are opportunities where we would usually look at that and do both.
Nice, makes sense. Tell us, again, for me, coming into the GovCon space, I hear this word factoring thrown around a lot. Can you explain what factoring is and what does that mean for people?
Factoring gets a bad rap, and it probably for reasons that are no longer applicable. For many years that was sort of, people believed that was an option of last resort, but it was a stereotype for a reason. It was egregious rates, and I think people were probably being taken advantage of when they were doing that, but that has come a long way. And so the factoring by definition is the sale of an invoice. You have an invoice, it is an accounts receivable, you sell that to somebody, to a lender. Typically it could be to anybody, but it's a true sale of that invoice to a lender. And so what happens is, at that point in a secured finance transaction, that lender takes that invoice, they've purchased it from you, they would then step into your shoes as if they were the person who were the issuer of that invoice.
Right.
So it's still in Eric's name, it's still in GovCon Giant's name on the invoice, doesn't say the lender's name. You've just sold that and all the rights to collect on that to that lender.
Okay.
Nothing else happens beyond that other than the right to. And in 99.9% of those cases, that invoice, you've sold that invoice, you've gotten cash up front because you're able to now go and pay the associated costs that go along to produce that invoice, putting people to work, making sure that you're meeting payroll and all the associated costs with whatever the work that's being done. And when that invoice gets paid, it gets paid to the lender because they've purchased it from you. Beyond that, there's nothing else special that happens. So I think going back to the questions about misconception, I think people get worried when they hear about that, but the reality is nothing changes in sort of like the day-to-day flow. Invoice still has your name on it, still goes out to your customer, the customer still pays in the regular payment cycle in the terms that you guys have agreed on and issued. It just gives the lender the right to step into your shoes in the event that that invoice doesn't get paid. It allows them to also take a secured position on the business. But again, that's nothing different than if you went to the bank and took out a line of credit or a term loan, the bank takes a secured position as well. So it's just a different financing vehicle that allows you to access capital and unlocked out of your accounts receivable. No different than if you were going to go and just say to the bank, I would like a line of credit or I would like a term loan. And so I think that it allows people to access capital just in a different way.
What else do you want people to take away from this conversation today?
I think I mentioned it at the top of our discussion. I want people to understand that there are other places to go beyond banks to access capital. And there are alternatives that have reasonable costs associated with them, and that there are people out there that understand and specialize in what they do. And I think that's why we have a lot of clients that have worked with us in the past and continue to work with us today, is because they come to us with the feeling that this sort of sigh of relief. And sometimes you can physically hear people like, they get it. Encore understands. Someone actually understands my business, because I shared that success story earlier. That gentleman had explained to me many times that he was blue in the face from talking to his bank and trying to get them to understand what his business was and the cycle of when he invoices and when versus when he runs his payroll. And it was just, you could see it on his face. It was just exhausting. And so I want people to know that you can access capital places other than a bank. And there are people that understand your business and understand what you do and can really be a good partner to help you grow your business. We're not here to throttle that and say, well, sorry, Eric, you've hit your limit, and until you pay it down, that's as much as you can borrow. We want to empower you to be able to grow your business and achieve whatever your business success looks like to you. We want to be a part of that, and we want to provide the fuel to get you to wherever that place may be. And that's what I want people to take away from this.
Nice. And we're going to see you at some conferences this year?
We'll be out there a lot. I think we have 22 conferences on the agenda for this year. So we'll be out there. We'll be back at your conference. So we're excited to see everybody, and make sure that you come say hi to us and ask us some questions.
All right. Craig, appreciate you, brother.
Thanks, Eric.
Thank you.